Somewhere in the world right now, a bank is making money because you are afraid. Not metaphorically, not approximately, literally, at this exact moment, financial institutions are converting human anxiety into quarterly earnings, and the system doing it is not hidden. It is not secret. It is sitting in plain sight, dressed in the language of protection, stability, and safety. This is how it works. In 2008, the global financial system came within 72 hours of total collapse. ATMs were days away from running dry. Governments were drafting emergency scripts they hoped they would never have to read. And in the middle of that genuine civilization-threatening panic, a small group of firms made generational fortunes. Not by solving the crisis, by owning the infrastructure the crisis ran through. That detail is worth sitting with for a moment, because it tells you something fundamental about how modern finance actually operates. It does not simply profit from growth. It profits from volatility itself, from uncertainty, from the very human instinct to protect what you have, even when protecting it costs you more than losing it would. Fear, it turns out, is an extraordinarily reliable revenue stream. To understand why, you need to understand what financial fear actually looks like when it is converted into a product. Insurance. You pay a company every month to take on a risk you cannot afford to absorb alone. Your house burns down, they cover it. Your car gets totaled, they pay. Simple enough. The company makes money because the average payout is lower than the average premium. They are essentially betting with enormous statistical precision that your worst day will cost them less than your ongoing anxiety is worth. That is not a criticism. That is genuinely useful. The problem is not insurance. The problem is what happens when the same logic scales up, when fear stops being managed and starts being manufactured. Walk into a bank in 2005. A mortgage broker hands you a document. 30 years. Low introductory rate. Affordable monthly payments. Sign here. What the document does not clearly explain is that the rate resets in 3 years, that the payments will climb by 40%, and that the entire structure of this loan was designed not for your financial stability, but for its own resale value. Because the moment you signed, that mortgage was no longer a loan. It became a product. It was bundled with thousands of other mortgages, good ones, bad ones, catastrophic ones, sliced into layers called tranches, rated by agencies paid by the same banks asking for the ratings, and sold to pension funds in Norway, insurance companies in Japan, and investment portfolios in the United Kingdom. The fear that made this work was yours. Fear of not owning a home, fear of being left behind, fear of rising prices, fear that if you did not buy now, you never would. The financial system did not create that fear, but it absolutely learned how to monetize it. Now here is where it gets structurally interesting. At the same time banks were selling you mortgage-backed securities, they were also selling something else. Insurance against those securities failing. Credit default swaps, which meant that the same institution that sold you the product and sold the product to investors was also selling bets on whether the product would collapse. Think about that geometry for a moment. You lose on the way up if rates move against you. Investors lose on the way down if defaults spike. And the intermediaries, the firms who structured, sold, and insured the whole thing, collect fees at every single stage, including the stage where everything burns. This is not an accident. This is architecture. The technical term for what was happening is called regulatory arbitrage, exploiting the gaps between what the rules technically allow and what the rules were designed to prevent. But the human translation is simpler. Someone figured out that if you can sit at the intersection of someone's fear and someone else's greed, you can charge both of them for the privilege of being there. The financial system did not evolve this way because of individual malice. It evolved this way because of incentives. When the person who sells you a product has already been paid before you discover whether it works, when their upside is locked in and their downside is either insured, transferred, or absorbed by a government bailout, there is no natural counterforce to complexity. Complexity hides risk. Hidden risk enables higher fees. Higher fees reward complexity. It is a loop, an extraordinarily profitable, largely legal, structurally reinforced loop. Now bring it forward to today, because this is not a history lesson. Post-2008, regulators tightened some rules. Banks were required to hold more capital. Certain derivative structures were restricted. The language of reform was everywhere. And in technical terms, some of the most dangerous specific instruments were constrained. But the underlying mechanism, the conversion of fear into financial product, did not slow down. It evolved. Consider the volatility index, the VIX. Officially, it measures expected stock market volatility over the next 30 days derived from options pricing. Unofficially, it is sometimes called the fear gauge, because when markets are calm, it is low. When investors are panicking, it spikes. What happened next is almost too neat to believe. Financial firms built products that let retail investors trade the VIX directly. ETFs and ETNs tracking volatility. Products that essentially let ordinary people bet on fear itself, on the index that measures panic. In February 2018, one of those products, the XIV, which was an inverse volatility fund betting that fear would stay low, lost 93% of its value in a single day. Billions of dollars evaporated in approximately 15 minutes of trading. The fund was liquidated. The firms that created it, structured it, and collected fees on it had already been paid. This is the uncomfortable math that keeps reappearing at every scale. When you buy insurance, you pay more in expected value than you receive. That is the product's design. That gap is the insurer's margin. When you invest in complex structured products, you pay fees on top of fees on top of fees, each layer justified by language that requires a law degree to properly interrogate. When you panic sell during a crash and buy back in at the top, which is statistically what retail investors do consistently across decades, you are not making a mistake. You are performing your role in a system that was calibrated around exactly that behavior. There is a statistic that surfaces regularly in market research, and it is genuinely uncomfortable. Over long time horizons, the average actively managed fund underperforms its benchmark index. The typical retail investor underperforms the average fund. And yet the total fees paid into the asset management industry, globally, are measured in the hundreds of billions of dollars per year. Someone is being paid extraordinary sums to deliver below average results. And the people paying those sums largely believe they are receiving protection, safety, expertise, management of their fear. Zoom out further, and the picture gets darker. The financial system's relationship with fear is not limited to individual products. It operates at the level of macroeconomic architecture. Interest rates move based on inflation expectations, which are themselves partly driven by consumer sentiment, which is partly driven by media coverage of inflation, which financial firms both produce and trade on. Sovereign debt markets price government bonds based on perceived default risk, ratings that are assigned by firms whose major clients are the institutions issuing the bonds. The feedback loops are everywhere, and at every loop, there is a toll booth. When a country's borrowing costs rise because bond markets lose confidence, even momentarily, even speculatively, that country's government must pay more in interest on its debt. That additional interest is paid to the same financial institutions that price the fear in the first place. The fear is real. The consequences are real. The people collecting the spread between your anxiety and your stability are also real, and they are not anxious. There is a version of this story where the conclusion is, the system is broken. But that framing misses something important. The system is working exactly as it was built to work. It is allocating risk, it is pricing uncertainty, and it is providing liquidity when markets freeze, capital when businesses need to grow, and insurance when individuals cannot self-insure. These are genuinely valuable functions. Without them, modern economies. The question that does not have a clean answer is this: at what point does pricing fear become producing it? At what point does an industry built on managing uncertainty develop a structural interest in sustaining it? Because here is the thing about a market that profits from volatility. It does not need to cause the next crisis. It simply needs to ensure that when the next crisis arrives, as crises always do, it is positioned on the right side of the trade. The tools are already built. The products are already structured. The fees are already embedded. And somewhere, right now, a very calm person in a very quiet office is looking at a screen, watching the number that measures your fear tick upward, and considering whether to hedge or hold or sell. They are not afraid. That asymmetry between who carries the fear and who profits from it is the most important thing the financial system never quite gets around to advertising.